Now, since the February report, the news on these indicators has been mixed. There are some signs that the labour market is loosening a little, though at a slower pace than we expected in February, and it nevertheless remains tight. Employment growth has been partially met by an increase in labour market participation, especially amongst younger people. The number of vacancies has come down from the very high levels as well. As Chart 5 shows, the ratio of vacancies to unemployment, which is a key measure of labour market tightness, has fallen as a result. Similarly, job-to-job flows have declined a little in the most recent data. In line with the data, businesses across the United Kingdom tell our network of agents that recruitment difficulties have eased in recent months. Employees are moving jobs less frequently, and employers are getting more applications for job vacancies. Nominal pay growth is shown in Chart 6, and that has also fallen back slightly, in line with our February projections. Near-term indicators such as HMRC payroll data and the KPMG REC salaries index suggest that pay growth could ease further later this year. And we hear the same thing from our network of agents. Meanwhile, services price inflation, in Chart 7, remains elevated, broadly as expected in the February report. This may reflect some rebuilding of margins as well as wage growth and the indirect effects of higher energy and other input costs. The extent to which firms have already passed through higher costs will influence the pace at which services inflation declines. So, while CPI inflation is expected to fall quite sharply as energy costs begin to ease, albeit at a somewhat slower pace than projected in February given the near-term outlook for food prices, the outlook for inflation further out is more uncertain and depends on the extent of persistence in wage and price setting. As shown in Chart 8, in the MPC's baseline modal projection, which is conditional on a market-implied path for bank rate that peaks at 4.75% in the fourth quarter of the year, an increasing degree of economic slack, combined with declining external pressures, lead inflation to fall materially below the 2% target in the medium term. But the committee continues to judge that the risks to inflation are skewed significantly to the upside, primarily reflecting the possibility of more persistence in domestic wage and price setting. We think the unwinding of second-round effects may take longer than it did for them to emerge. The current circumstances are so unusual, however, that it is hard to be precise about the extent of this asymmetry. So we've not made it part of our baseline modal projection. Nevertheless, the MPC judges that relative to the baseline projection of significant declines in inflation to levels below target, there remains material upside risks over the medium term. Reflecting those risks, conditional on the market-implied path for bank rate, the MPC's mean forecast path for inflation is at or just below the 2% target at years 2 and 3. I want to emphasise the point that having this large upside risk on inflation does not call into question meeting the inflation target in our projection using market rates. Now, upside risks may not materialise, and so the MPC's baseline modal forecast remains for inflation to fall below the target in the medium term, conditional on the market path for bank rate. Let me turn to the transmission of monetary policy. Monetary policy is now working to bring inflation down. Changes in bank rates seem to have passed through, as would be expected, into new mortgage and corporate borrowing rates. Overseas bank failures have resulted in asset price volatility since the February report, and spreads on UK banks' wholesale funding rose. But this was short-lived, implying little impact on the interest rates facing households and companies. While pass-through into household sight deposit rates has been muted, rates on term deposits and fixed-rate bonds have risen more in line with changes in reference rates. These changes are still working their way through the economy. For example, while we have seen higher rates being quoted on new mortgages, illustrated here, by rates on the new 2-year 75% loan-to-value mortgages, that's the blue line, as well as the effective rates on new mortgages more generally, which is the orange to red line, The effective rates on the whole existing stock of mortgages, which is the purple line, are still catching up. Given such lags in the transmission of monetary policy, the rise in bank rates since December 2021 will weigh more on the economy in the coming quarters, and the MPC factors this into its policy decisions. The bottom line here is that over this period of time, the mortgage market has changed to being a more fixed-rate market. So let me conclude with the monetary policy decision today. At this meeting, the committee has voted to increase bank rate by 0.25 percentage points to 4.5%. In doing so, the MPC is continuing to address the risk of more persistent strength in domestic price and wage setting, as represented by the upward skew in the projected distribution for CPI inflation. The pace at which inflationary pressures ease will depend on the evolution of the economy, including the impact of the significant increases in bank rates so far. Uncertainties around the global financial and economic outlook also remain elevated. The MPC will continue to monitor closely indications of persistent inflationary pressures, including the tightness of labour market conditions, the behaviour of wage growth and services price inflation. If there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required. The MPC will adjust bank rate as necessary to return inflation to target sustainably in the medium term, in line with its remit. So thank you. And with that, Ben, Dave and I will be happy to take your questions.
Thanks, Andrew. Usual process for questions, please. Once you get a hold of the microphone, if you could let us know your name and where you're from. And if you could limit it to one question apiece, please, so we can get round to everyone. We'll start with Ed and then Sue.
Thank you. Ed Conway from Sky News. In some senses, some people would say that this is the biggest test of the banks since becoming independent. This rise in inflation, the rise in interest rates. What would you say to those who say that it's effectively failing that test, failing to see the rise in inflation, failing to see how sticky it's become now it's up at the top, failing to understand the nature of food price inflation as well? Do you think that those failures matter in your ability to maintain credibility?
Well, I think you're right, Ed, that the backdrop to this is that the shocks that have been hitting the UK economy, and of course the global economy actually as well, we must look at it through that lens as well, have been much larger. So we've set these shocks out, and of course I've referred to a lot of them in my opening remarks. The largest one of which is the impact of the terrible war in Ukraine on both energy and food prices, no question about that. And of course it's the test of this regime is how we deal with them and how we return inflation back to target. Now, I think you can look at that through two lenses, therefore. One is what is causing the shocks. The second is, how are those shocks anticipated, and then how do we deal with them in terms of returning inflation to target? Because that is the objective of the regime, obviously, that we have sustainable inflation over the medium term, so sustainably low at target inflation. That is what we're doing. We have to adjust from meeting to meeting as we see news. And I'll pick on one piece of news that you mentioned. I think the point on food prices, let me just come to that. There is a very big underlying shock in food prices, and I showed the chart which showed the same thing is going on in Europe as a whole. Now, I think the news that we've had is not about persistence in the sense of long-run persistence. It's the question of how, over what time, this shock works its way through the system, if you like, and how quickly we expect that to dissipate. Now, what we're hearing, and as I said, I hear it around the country, which I've been doing a lot since we were last here, is an expectation that we will see a reduction in food inflation. Indeed, we're already seeing some of that beginning. But it is taking longer, and the reasons I hear that it's taking longer are sometimes to do with the impact of energy prices in food production, sometimes to do with hedging approaches that have been used at the commodity price level, so that although, as I said, commodity prices started to fall last year, it's taking longer to come through. Now, I think, I'm happy to sort of, in a sense, debate, well, how much of that is predictable and how much of that is emerging. But those are the things we have to deal with. And yes, we do revise our views as we see new evidence. I think that's appropriate.
Hi, Sue Chan from The Telegraph. Just following up on that then. I mean, this is the biggest upgrade to your growth forecast in the MPC's history. What would you say to people who said that in the past the Bank of England has been too gloomy? And just on those food prices, given the work you've done on price setting behaviour and how it's changed, do you think supermarkets have been as quick to cut prices as they have been raising them?
Well, on the upward revision, and you know, Ben may want to come in on this as well. I mean, if you look at what's happened, well, let's take it back to when we were sitting here in November. There has been a very substantial fall in energy prices. I mean, the biggest news has been a very substantial fall in gas prices, and that does feed through, clearly, and that's fed through in a positive way. So, you know, we take that on board. That was not anticipated. Let's face it, when we were sitting here in early November, we were looking at a prospect of a very difficult winter, you know, some probability that Europe was going to, you know, experience periods where gas supplies may be restricted. It all looked very bleak, and that was reflected in pricing. And that has turned out not to be as bad as expected. So that's a piece of, you know, that's one piece of news. Second piece of news, as I said, is that we've obviously at this time taken on board the, you know, the measures that were introduced in the budget, which has happened since February, and you know, that has a positive effect in this, certainly in the year or so ahead. Thirdly, global conditions have improved. So I'll give you another example of that. You know, the impact of China's ending of its zero COVID policy, I think, has been much more muted than many people expected it to be. And the fourth factor, as I said, is, and here I think we do say, yes, we understand this, that I think the economy has turned out to be more resilient to this than we expected it to be. So, you know, all of those things come together, and it's, you know, it's appropriate that we revise. Can I make the point? I mean, I will slightly to put a downer on it for a moment, if you don't mind. I mean, yes, it's a very big upward revision, but the level of growth is still it's still weak. Let's be honest. I mean, we have to look at both. We have to look at both change and level here, I think. I mean, to get the sort of the proper position. Just on supermarkets. I mean, I don't want to comment on sectors because, frankly, we don't have what I would call sort of consistent data. I would say in the aggregate data, and Ed rather helpfully published this chart this morning, which is one we have as well, which is the aggregate position for the UK as a whole, and it's interesting to look at because it doesn't tell the same story that, for instance, the somewhat similar chart that the ECB has published for the euro area. So you don't see the same picture in terms of the contributions, the component contributions. Do you want to?
Yeah, so I mean, the aggregate chart shows there's no increase in the profit share of national income. That's the comparison with Europe, where it's slightly different. Just on the general nature of forecasts, one has to remember, I said it before, these are conditional forecasts. So when the conditions change, the forecasts change. Maybe other reasons forecasts change, but that's certainly a big one. And you go back to, say, last August, I mean, gas prices were close to 500 pence a therm, they're now 80. What that means is that if you look forward, household energy bills are now over 4% of income lower projected than they were in the August forecast. Partly because we assumed that those prices would remain, and now they've come down. But I mean, that is a huge change in the conditioning assumption. It gives a big boost to the economy. I think it's why you've seen growth improve significantly in Europe, and continental Europe as well. As it happens, the timing of that turn here and in the euro area was precisely when wholesale energy prices started to decline. Trough was September, October in high-frequency measures of growth like the PMIs. And interestingly, you haven't seen the same increase in the US because you never saw the same rise in energy prices in the United States. So this is a really big reason for the change in growth, both in the data and in the forecast. And another conditioning assumption, incidentally, that's different in August and November compared with now is that the market path of interest rates is also lower now. So these things one should always remember, and one should remember more generally the conditional nature of the forecasts we make.
And if I can just put some numbers to Andrew's point, as he said in his opening remarks, we're forecasting growth now of 0.25% annual average this year, 0.75% next year. That's in the table on page 28. That is up from February, where we had 2 negatives. So we have moved from, -0.5 this year, -0.25 next year, to 2 small positives, and that does reflect the, I mean, we've been consistently stressing that the economy's been hit by these negative shocks. What's happened to energy prices more recently is a positive shock for the global economy, for the UK economy. And we've also seen this very resilient labour market. We're now forecasting unemployment will stay below 4% this year. And we're beginning to see some improvement on inactivity. That was another negative shock we called out. It's more concentrated in students at the moment, but these are positive underlying developments, but they're against a backdrop of still very or relatively weak growth compared to historically. But it's that kind of context which has enabled us to revise up our growth projections.
Phil and Maureen?
Yeah. Hi there, Phil Aldrich at Bloomberg. So energy prices have fallen, but your inflation forecast is actually higher. You've repeatedly underestimated where inflation will be and how far rates will need to go. The markets have been right, and you haven't. Is that a fair sort of takeaway from this? And I mean, in November, you said rates would. And the other point being that we're going to have rates at 5% at the end of this year, and 1% at the end of the 2-year forecast. Do we need to do more on rates or less on rates? How do we read that?
Well, can I take the second question first, because I think it's a very important point. We've been very clear in the guidance, and we've repeated the language this time that we used in the committee in March, that we will be guided by the evidence. So I want to be very clear on this. We are not giving what I would call a directional steer on rates today, as we didn't last time. We will be guided by the evidence, and that's very important. Now, we've repeated the point we've made before, which is if we see further signs of greater persistence, then, of course, we'll have to act. But let's be very clear, and it goes back to what Ben was saying earlier. That's a conditional statement. It's not an unconditional statement. It's a conditional statement. So in other words, it states the conditions under which we would have to act. But to be very clear, we're not giving any steer. We're evidence-driven on this occasion. Now, I'll make one point on your first question. I don't know, Ben or Dave may want to come in as well. And it's this. The news that we've had on inflation, and you're right, inflation is, it's just under 1% higher at this point in time than we expected it to be in February. Interestingly, as I said in my remarks, that difference is actually really not really about the persistent element of inflation. So if you look at services, if you look at wages and remuneration, they are actually pretty much on track with what we thought in February. The news is mainly on food and clothing. And certainly, yes, I mean, food inflation has been more persistent than we thought it would be. And I'll just repeat the point I made earlier. It appears to be taking longer for food price pressures to work their way through the system this time than we had expected. But as we said before, these are very unusual times. I mean, the models have to be treated with caution here because the transmission of these sorts of shocks is highly uncertain. I don't know whether.
Yeah, I just wanted to I mean, I'm not sure on what basis you say the market's got it right. We have a market break-even rate for RPI inflation. That certainly a year or two ago was not predicting 10%. So hang on, I don't think that, hang on. Can I just answer? I thought you meant. No, I don't think that's true. You talked about inflation, though. I thought you said the market's got it right. You were talking about inflation, I thought. No, well, let's deal with the inflation stuff. And we don't predict interest rates, so I'm not sure where that comes from. But inflation, the markets were certainly not expecting, no one was expecting 10% inflation a couple of years ago at this point. I want to mention something in the context of Ed's question as well, and the sort of big picture thing. So the scale of these rises in import prices we had 21-22, particularly last year, are enormous by historical standards. So roughly speaking, depends a bit how you measure it, they cost the UK collectively about 5% of income. That's by how much? Over 5, my guess. I had a talk a few months ago where I tried to quantify it. I think it was about 5.5%, the number, in the year to the third quarter of last year. which I think is roughly speaking twice or even more than twice as big as the hit from the rises in oil prices in the mid-1970s. Now, at that time, when headline inflation went up, and this is the point I wanted to come back to in terms of Ed's question, the result was a huge rise in inflation expectations more generally in the medium term. That hasn't happened now. We did see these break-even rates, expected medium-term inflation rates, go up quite a bit, but they actually peaked over a year ago. Now, they're still too high for our liking, but they are nothing like the response in the 70s, and that is the value of this regime. And you're absolutely right, it's critical that we maintain that value and maintain that credibility. And the task, as Andrew said, is not somehow to predict that the war is going to happen or even its consequences for the supplies of energy and food, because I'm not sure that's possible. It is to respond, and to respond to a way that maintains this credibility and ensures that inflation gets sustainably back to 2%, and that's what we'll do.
Can I just come in with one point? Page 89 of the report has a chart that we always have at the back of our report, which is comparing our forecast to the average of forecasters' projections. And what you see there is that for Q2 next year, our modal projection for inflation is actually noticeably above the average of outside forecasters. Now, interestingly, for the following 2 years, we're below, but I made the point about the way in which the committee had looked at, put in a mean projection as well, which has the inflation skew in it. If you were to compare our mean projection with the outside of the average forecast, and by the way, we don't know to what extent these outside forecasters use means and modes. I can't tell you the answer to that question. Actually, our mean forecast is pretty much the same as those things. So, I just would push back slightly on where we are relative to the outside world. Dave, sorry, I cut across you.
I was just going to focus on the very short-term forecast, and obviously recognising that the conditioning assumptions for those short-term forecasts can also change. We are having to deal with the whole range of shocks as they play out, both negative and now more recently positively. But just to highlight, we put these numbers now in table 1.c on page 25. We expect inflation to fall to 8.2% in Q2. So that's actually slightly below what we had in the February forecast. Now, that's because energy prices and the extension of the energy price guarantee are supporting things there. Moving in the other direction, though, is this recognition that food price inflation has been higher than we and I think others thought. So you've got those two offsetting factors. And we're trying to be transparent about the path of inflation. Clearly, it's too high at present, as Andrew stressed, but we do see it starting to come down sharply from Q2 and then falling through the rest of the year and being below target within 2 years' time. So, in a sense, those based on the current conditioning assumptions and our forecasting judgments, that is the way to frame the way we're approaching this. As Ben says, though, if you look at those market-based measures, for example, of break-evens, you get no sense that there is kind of a challenge to the credibility of the framework. We're not seeing that de-anchoring of medium-term inflation expectations in markets, which would be something that would more go to Ed's emphasis on credibility. We're confident about that.
Maureen.
Hi, Mehreen Khan from The Times. Just to go back to the food prices, I'm interested in why or how the bank seems to have been a bit blindsided by this story, given that you have a network of agents. Is it that your agents are not asking the right questions, or even that the businesses are not really replying honestly about their pricing behavior? And given that we sort of failed to foresee what was going to happen with food prices and to some extent goods, why are you so confident that even though they will come down, as you said, a bit slowly, that actually maybe companies are they replying honestly about their future behavior?
It's a very good question. I think the issue is the degree of persistence in food inflation that we've seen. I mean, you can say you can go back to the underlying shocks, but that is, that is a question of how you read the impact, particularly of what's going on in Ukraine, I'm afraid. I mean, you may remember about a year ago I said, something which was interpreted quite dramatically. Wasn't, it wasn't really meant in that sense, but more to make the point that food is a big issue in the shock that we're seeing. Now, the question then was, how long was this transmission going to go on for, and was it going to go on for, longer? Well, as it's turned out, it seems to have gone on for longer than certainly sort of past experience would illustrate. And I'll pick out two. I mean, I mentioned a few minutes ago, but I'll just quickly I think there is an element of the impact, particularly of energy costs in food production, which I think probably, yes, probably didn't come through as much as it should have done. So I think that's true. I think the harder thing to judge, as I mentioned earlier, is how, and by the way, I should say, one of the things I find, our agents find, I find when I'm going around the country, of course, is that the energy question, we talk about the energy question a lot for households, but it's important also to talk about it for businesses. And the energy question for businesses is very complicated because it really, businesses have contracts that run for periods of time and get reset depending on when they get reset, and there's no fixed time at which business energy contracts get fixed. And so, businesses are having very different experiences. I mean, I talk to a lot of businesses. Their experiences are very different because it depends just on when you reset your contract as to what your experience is. And so that can come through in very different ways in terms of impact on pricing. But I think the other thing I'd mention is this question about hedging. I mean, how much hedging was done and for what period of time, and how hedging behavior responded to the severity of the shock. And I think, I think there's a lot of uncertainty, and there are things we learn from this. So, that I think is true.
Andrew, do you mind if I...
Do you want to come in? Yeah.
Sorry, yes, just a couple of things on there's a good couple of charts. Look, all the charts are good, but particularly good is the middle of the report, page 57 and 8, a couple of things on food price. Actually, the one on 58, Andrew already showed you in the introduction. The fact that food price inflation is so high is not just because of, quotes, pricing strategies of firms. I mean, as Andrew indicated, their costs have gone up enormously. Minimum wage went up, energy prices much higher. There's a lot of energy use in food production. And we don't just rely on what food retailers tell us about what they're going to do, because we know that what they do will be driven by these other things to some degree. So if you look at, this is for goods, X energy on the left, so that's more than just food, at the left-hand side of chart 2.18. We can see here, there's quite strong evidence from the producer pricing side that we think the price of retail goods will decelerate, that their inflation rate will fall. You can see how tight that correlation is. For food, output price inflation hasn't come down as much, but it does seem to have peaked. You see that the same in other countries. If you look at the input prices for food producers, that rate of inflation has been falling for several months. So we do not simply listen to what the retailers tell us. We construct the forecast a little more carefully. And I should emphasize that although we have definitely put up the food price inflation for a while, by the time you get to the meaningful part of the forecast for us, sort of what we call a policy horizon, the point at which current changes in monetary policy would really have an impact on inflation, so 18 months, 2 years and beyond, it's not having an impact. We still think, based partly on this, partly on what we're seeing in underlying commodity prices, that food price inflation will come down significantly. It'll just take a little longer than we thought 3 months ago.
I mean, just add something. I mean, it's getting very specific now, if you don't mind saying. So the level of milk prices has come down. Actually, that's the level, actually, just to be clear, in recent months. But just giving, I mean, I don't live my life in bakeries, but I have been to a number of bakeries around the country recently. I know you may think I do from looking at me. And what they've said is quite interesting. I mean, their response in terms of buying, commodities forward to hedge themselves changed somewhat in response to seeing the nature of the shock they were. There's a war going on in one of the largest grain-producing countries in the world. So, they factor that in, and I think those judgments, Yeah. I mean, we have to learn about those judgments as we go along.
Let's go to Jumana and Larry.
Hi, Jumana Bersachi from CNBC. Noted your comments on domestic inflationary pressures. Can you hear me?
Not terribly well, but
Let me go again. Can you hear me now?
oh, that's better. Yeah.
Okay. Noted your comments on domestic inflationary pressures. Private sector wage growth is running north of 7 percentage points. In order to bring that in line with your price stability mandate, many economists say it needs to be closer to 3 percentage points. How are you going to bring that down without bringing about a recession or a massive uptick in the unemployment rate?
Yeah, I mean, that's a very good question. We already think it is coming down a little, right? And Andrew showed you a graph with some of the indicators. What is highly unusual about this is it's not just economic slack or the rate of unemployment that has driven wage growth. It is very much the second round effects of these huge rises in import prices. I gave you a number earlier for this enormous cost of living squeeze we've had for the country as a whole. And so everyone's experienced this. And the result of that big hit to real incomes, we think, is that for quite understandable reasons, firms and households try and protect those real incomes by pushing up their nominal prices and wages, respectively. Now, collectively, unfortunately, that doesn't really solve the problem because it's just a problem posed on us collectively from the outside. But this is the reason why we think those predominant reason why wages have accelerated and domestic prices have accelerated, for example, in services. What we've seen now, as Dave emphasized and Andrew emphasized earlier, is a lot of those global prices are declining. There's a breakdown somewhere of our wage forecast, and we expect, for that reason predominantly, so independently of the rate of unemployment, and that will bring down wage growth. And we're actually relatively cautious about that. Andrew discussed the skew. That represents a judgment that this unwinding of the second round effects will actually take longer than the models are telling us it will. The models are saying, yeah, it'll all unwind quite quickly, and you'll get quite a lot of fall in wage growth and domestic price setting without the need for higher unemployment. We've been more cautious than that. And indeed, unemployment does go up in the forecast, less than in February, but it does go up. But I think you have to understand that with these highly unusual circumstances and what has driven up these rates of growth to begin with, it's partly the tight labour market, but mostly it's other stuff, and that other stuff is unwinding.
Larry Elliott of The Guardian. Interest rates have now gone up 12 times in a row. Inflation, as you say, is still too high, above 10%. By any stretch of the imagination, that seems to me to be a policy failure somewhere along the line. Now, rather than blaming Vladimir Putin for this or wage bargainers trying to negotiate pay rises for their workers, isn't it time for the bank to own up to its part in this policy failure and say, sorry to the householders who are going to be paying more for their mortgages, sorry to the small businesses who are facing much higher overdrafts. Isn't it time for the bank to say, sorry, we messed up?
Well, Larry, we don't use the language of blame. I really must be clear on this. I mean, I do read, articles which, are cast in those terms, and I don't use the language of blame. What I do think we have to do is set out the underlying shocks that are going on in the world economy and the UK economy that in a sense can cause this situation. And we do push back. Ben made a speech on it a couple of weeks ago on some of the arguments which says the underlying cause is not to do with these other things, it's to do with the way in which monetary policy has been set in the past. But I want to distinguish two things here, so that's the first point I'll make. I think it's important to set out the causes, but not in the language of blame. We're not using the language of blame. If you want to argue that the war in Ukraine has not caused inflation, I think we'd be happy to have that debate with you, but we don't agree with you, I'm afraid. Now, the second, I think, approach to this question is in some ways, I think, more important, which is, okay, yeah, let's take those sort of causes and then say, did you as the Bank of England respond either quickly enough or forcefully enough to those causes? Could you have anticipated those causes and therefore offset the experience? Now, I think that's a debate that we've had for some time, and I think happy to have it again, as it were. I would make the point that as I've made many times before, that there is a level of what if you don't mind me saying so, hindsight in many of these judgments. The other thing I would say, as I think Ben has set out, and certainly Silvana Tenera has set out in speeches they've made in the past, that if you take Ukraine as a good case, you have to make two assumptions. One is that we could have foreseen the war far enough in advance to have actually taken action to offset it. So that's I don't get beyond that point, but I'll set the second one out just for the sake of argument, if you don't mind. And then that you would have taken massive offsetting action in the middle of the COVID recession to offset it. Now, we could debate that second point, but actually, I'm afraid I don't even get to that point, because the idea that we could have foreseen the Ukraine war, 18 months or 2 years before it happened, I'm afraid that's a stretch beyond to which I wouldn't go. But that's not the language of blame, Larry. I don't want to use that language. I think we should have a debate about, how does policy respond? But I think it is important that we set out the underlying causes here.
Chris? David?
Thank you. Chris Giles from the Financial Times. I'm not going to use the language of blame nor the language of hindsight, just the evaluation. The MPC says there's pretty much a 50-50 chance that inflation will be above its target all the way to 2026. That would be 5 years of above target inflation, 50-50 chance. Is that good performance? How would you evaluate the performance? Is that something you would be proud of?
Well, as you can see from the way we've set the presentation out, of course, we always present the fan chart, so you can always do that. Both on the mean case, so let's stick with the mean case for the moment, which is the one that where we've put more persistence in than the model would suggest, and that really goes to what Ben was just saying about asymmetry. It brings inflation back to target sort of towards the end of next year. Now, of course, there's a debate about how quickly we should bring inflation back to target and how appropriate are various different settings. And we have to balance that out, because we've also got language in our objectives about trade-offs, and we will go on considering very carefully as we meet what is the right path to bring inflation down on. But I think this path that we've got is not unreasonable given the scale of the shock that we've had. We have to bear in mind the very large scale of the shock that we've had. And I think we have to sort of consider, yes, you could consider paths that would be faster, because after all, bear in mind, you've quoted one side of the fan chart, you can quote the other side as well. But I think that's, what we have is, I think, an appropriate path. And I'll just go back to the point I made to Phil's question, which is we will obviously be driven by the evidence at each meeting and consider appropriately, but there is no bias at the moment in our setting of rates looking forwards. Dave?
And just to use the framing you use, Chris, around, I think any evaluation would have to take account of the fact that we and the global economy has been hit by two once-in-a-century shocks in quick succession. Again, not using the language of blame, just recognizing the world that we and other central banks find ourselves in. So we have a pandemic, then we have a major pandemic, certainly once in century, first major war in Europe since the Second World War. And these have had very significant impacts on prices and on price setting. And if you look back at the track record, we started putting up rates in December 2021 when Omicron was, we were still trying to make sense of the Omicron variant. When I say we, I mean the country collectively. I remember there was quite a lot of surprise at that time that we had put up rates against that health backdrop. And then, as I've described, the shocks we've had from the terrible war in Ukraine since then, which are still playing out, and they're playing out in different ways for different sectors. So we've discussed a lot today, rightly, what's happened to food prices, but also, and you know, that originates with the war in Ukraine in terms of the shocks from that, but also there are other shocks that have hit food prices, and we as monetary policy makers have to deal with that world. And I think an evaluation of us and, you know, of other central banks, because of, I mean, it is the case that we started to tighten policy before other central banks, particularly before the Fed and the ECB, has to take account of the situation that we found ourselves in over this period, which has just been an extraordinary period for the world economy, for the UK economy, and for monetary policy.
We've got these ribbon charts which show these probabilities. Their probability of being below. No, but you said it's not. It's not late 26, Chris. It's, I think someone told me the first and second quarter of 25, just to be clear. And it's below 2% throughout afterwards. No, of course not.
No, it's
but
not.
Of course not. That's not what I said. I just wanted to be accurate about the premise of the question.
The point, Chris, I think we're all making is the debate we're very happy to have is what is the the best way to refer to go back to price stability given the shocks we've had. Dave made the point very well. These are two huge events in history.
David was next.
Sort of David Milliken from Reuters. I know sort of in the monetary policy report it talks a little bit about sort of the lagged effect of sort of past tightening. And obviously sort of this is difficult to sort of judge. Sort of things have changed sort of quite a lot sort of since the Bank of England's last tightening cycle. I was wondering sort of how confident can you be that you're not sort of in the process of over-tightening? Because obviously you've got sort of two members of the Monetary Policy Committee who for a number of months have sort of voted against sort of rate rises. So how sure can you be that you're not sort of overshooting here?
Well, it's a very good question because during this round we have spent, I think appropriately, a lot of time on what we call the transmission mechanism and how it's changed. Now, I showed the chart of the mortgage market very deliberately because that is probably the most interesting, I think, area of the transmission mechanism for the reason that it has changed so much over time. Here we now have in the UK a predominantly fixed rate mortgage market. Not fixed rate in the way the US has, obviously, but it's still a fixed rate over a period of time. I think around about 85% of the stock of mortgages in this country is now fixed rate, whereas if you go back, I deliberately showed the long run version of that chart to take it back to a point when that was not the case. And as that chart showed, I mean, we've still got quite a lot of pass-through to come in that world, more so than we would have had in the past at this point in time. And so, yes, I mean, two things. That is a very lively subject of debate in the committee. However, we factor in what we think is the pass-through now. So it's all factored into our assessment. But yeah, of course, there's still, because we haven't seen this sort of thing happen before, we haven't had a tightening cycle with this mortgage market. There is a lot of debate around that, and I'm sure there has to be quite a lot of judgment in that debate.
We'll go to Deirbel and then Liam.
Hi. Oh.
Not terribly well. Thank you.
Thanks very much. Derval Jordan from the BBC. I'm just wondering, what do you say to people who are struggling to make ends meet? Do people, as Hugh Pill suggests, need to accept that they're poorer?
I am very, 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 and we are very conscious that this inflation, all inflation is difficult, and particularly for those least well off. This inflation is particularly difficult for those least well off because it is concentrated, as we've discussed today, in what I call the essentials of life, food and energy. And people on lower incomes have a larger proportion of their consumption is the essentials of life, food and energy being obviously the largest elements. I'm very, very conscious of that point. We face the difficult situation that, as Ben has said, there has been a very substantial hit to national income caused by these external shocks, which take national real income, which takes the form of higher inflation. That is passing through, and we have to deal with that. Now, you mentioned what Hugh said. Let me be very clear on this. The economics of the hit to national income are clear. But I think I want it to be very clear that we are very sensitive to the position of people particularly all people, but particularly people on lower incomes. I don't think Hugh's choice of words was the right one in that sense, I have to be honest. And I think he would agree with me. But what I'm afraid we can't duck is this very big hit to national income, which we have to deal with, and we have to deal with it. And of course, as we've said a lot, we have to deal with the risk that leads to second-round domestic inflation effects. Ben?
I just wanted to say in that respect something that's, I think, important to emphasize, which is that because, as I said earlier, some of these global prices, many of them, have stopped rising, and indeed some, those related to the pandemic shortages, for example, but most obviously energy prices have actually been falling. There is some relief here, and you can see it in this forecast. I don't want to overemphasize this because the levels of these prices are still much higher than they were before, and will remain so in this forecast. But in terms of the growth rates, there is a little relief. So if you look at real labour income, for example, in this forecast, in the year to the fourth quarter of this year, so through the course of 2023, that is now projected to grow, and to grow quite a bit by over 2.5%, which would actually be the best annual growth rate we've had for about 5 years. Now, in the long run, that growth rate depends on improvements in productivity and so forth. And it's not the case these prices will fall forever. But that fall is beginning to provide a little relief, and we are beginning to see real income growth through the course of this year.
Thank you, Governor, for your presentation. We see now that inflation in the US is 4.9% in April, 7% in the Eurozone in April. Just putting this in international context, why do you think it is that UK inflation, 10.1% still in March, as you now well know, has not only been higher than across much of the advanced industrialized world, but also far from transitory, has actually been particularly stubborn?
Can I make one point? I think Ben wants to come with another point. Can I make it's a rather sort of mechanical point, but I think it's important to make at this point, because you're right to point out, Liam, why has inflation not come down, faster in this country? There is a particular point about energy prices and the energy price setting mechanism in this country. Actually, it has quite a lot to do with the fact that if you go back, we go back a year now, actually, before the arrangements were changed, the Ofgem price setting mechanism was set only every 6 months. That's important. The reason I say that is because that's why we have a very big base effect coming in for the number that's going to be the April number that's going to be released in 2 months, and why actually those base effects have come through rather faster in continental Europe or some. I mean, it's a bit of a mixture, obviously, but I just want to emphasise that's an important point in the current comparison. There was a bit of a flip side to that actually a year or so ago, but that's a very important point in the current point of comparison. And I think
that is actually the vast majority of that difference with Europe is that. So if you look at core inflation rates in March, we are higher than Europe, 6.2 versus 5.7. But the vast bulk of that, what is actually overall a 3.2 percentage point gap, is this point about energy. So coupled with, if you include petrol prices, or overall energy, domestic energy and petrol, it's still 40% higher in the UK. It was in March, 40% higher than the year earlier. In Europe, the number's negative. In the United States, it's minus 10%, that inflation rate for energy. And a lot of that has to do with the way that the Ofgem cap is set. It's much more lagged, therefore, the effect. So the effect of these rises is still here for us. I mean, it will come down, but it will come down quite predictably because we can see exactly what's going to happen to the cap. We know what happened a year earlier, but it will take a little longer. So this is probably, I don't want to, probably the maximum gap. But that is the vast bulk of the difference, is this difference in energy prices. So with the US, by the way, the difference is not just timing, but as you know, they never saw the same rise in wholesale gas prices to begin with.
Jack and then John Paul.
Hi there, Jack Bonnet from City AM. I just want to go back to the transmission mechanism that you touched on there, and there's obviously a bit in the report today saying that it's kind of been blunted the way it transmits through the mortgage market because we've now got a new shape of mortgage market. If you coincide that with the inflation forecast, you're saying quite a lot of the drop is being driven by supply side measures, so energy prices falling, food prices falling as well. Is there a question amongst the MPC now that the actual effectiveness of monetary policy in taming inflation, how effective is it, and has it been blunted as a result of a change in some of the economic structure in the UK?
Well, I think Dave wants to come in. I wouldn't use the word blunted. I think we have to adapt our view of the transmission mechanism to the markets that we have around us, as it were, and the mortgage market has changed. And therefore, we have to adapt our view of the transmission of monetary policy, and of course that then feeds back into our decisions. So, rather than blunted, I would say we have to in a sense we have to adapt to what the transmission mechanism is. Dave?
Yeah, I mean this cash flow effect that is driven by the nature of the mortgage market and the structure. I'd say it's slowed rather than blunted relative. It's going to take time to come through, but as the chart Andrew showed, we think on the stock only about 70 basis points has come through out of a total. If you look at quoted rates on the most popular products, you're up at 300 basis points. So there's a long way to go, but that will build up. This is not, although we've put all these charts in the box today, this is not news to us. We knew that the mortgage market had changed, and we've been factoring it into our forecasts for some time. Overall, I mean, we're continuing to work on this, but overall, we don't think that the overall impact of the transmission mechanism is any less than we think it's broadly the same. And those impacts on demand are coming through. They will come through more market. You'll see that if you look at the summary table in the forecast, it shows that we go from a position of currently excess demand. As slack builds up, we will, and other factors take effect, we will move into an opening up of spare capacity. We do expect some rise, regrettably, in unemployment, but that we think that is necessary. It's a rise now to 4.5%, so less than the more than 5, peak or endpoint in unemployment we had before. So those features are still playing a part, but you're right as well to emphasise the role that the supply side and supply shocks have played throughout this period, in which we consistently talk about, because we think they are relevant to the inflation that we're experiencing and how price setting is developing. But the demand effects from what we're doing and what we have to do in terms of monetary policy, we are still confident are going to come through.
Last two questions, John Paul and then Halia.
Thanks, John Paul Ford-Rojas from the Daily Mail. Just following up partly on a previous question, you said that Hugh Pill's language wasn't the right language. Perhaps you agree that it was insensitive, as some people think. At the same time, the head of the London Stock Exchange is saying that executives need to be paid more to attract them to London, which it seems quite starkly different from what you're saying. And you've also said in the monetary policy report that the pass-through of higher rates to savers is unusually weak. So I just wonder whether you think that people in your position, people in the city, people at banks ought to be setting an example. So should Hugh Pill, should others in the Bank of England be refusing pay rises?
Well, that's what
Should-
I've done. Can I just say that's what I've done? So, I mean, just as a matter of fact.
Okay.
Yeah.
Should people in the city stop talking about higher pay for executives, and should banks be doing more to pass through rate hikes to savers?
Well, just to reiterate, certainly, look, I want to speak for myself. I have not taken a pay rise, so that just to emphasise that point. On the level of pay rise for executives, I mean, it's obviously these things are set by firms, not by us. I've been very clear as my past and in my present as a regulator of banks that we have quite extensive regulation which seeks to create the right incentives for a senior executive remuneration, but it's not about the level. It's about I'm very clear on this point. It's for firms to set that. On your point about deposits, I think, and we go into this quite a bit in the report actually. So it is true that the rate of pass-through to sight deposits has been muted. I think we use that word actually, muted. The rate of pass-through of our interest rate rises to term deposits and fixed rate deposits has actually been much faster and is not very dissimilar to the increases that have gone through into the official rate. Now, I'm not surprised in one sense by that, because let me again put my bank regulator hat on and financial stability hat on, since the global financial crisis, the liquidity regime has been changed so that we greatly incentivize banks holding term deposits. Not got time now, but if you go back to the recent experience of Silicon Valley Bank and so on, you'd probably understand why. I mean, that's a sensible thing to do. Now, what we have seen is, interestingly, but not surprisingly, I think this is sensible, is that there's been some flow out of sight deposits into term deposits, it appears, and that's exactly what you'd expect given the pricing differential. And the point I would make is that I think it's important that people shop around and that we have competition in the banking system. I mean, those pricing mechanisms should take effect in that sense. There's one more.
Halia Ibrahimi, Channel 4 News. Governor, you talked about the mortgage market changing, but are you worried about those people who are rolling off their fixed-term mortgages? There's millions of them, and for them, the impact of these 12 rate rises is astonishing and very difficult.
Well, let me say again what I've said before, because it's very important that we are very, very aware of the effect that this inflation is having and the consequences of this inflation is having on households. So please do not think that we're not in any sense we are. Now, I think it's important that we obviously are very aware of what these effects are, and as Dave was saying, that we take those into account. That's important. The other thing I would say is, and something we've done, again, I'll draw on the financial stability side of the bank for a moment, that again, for the last, not far off a decade now, we have had policies in place to limit the proportion of mortgages which are at the more sort of the extreme end of the sort of the loan-to-income ratio. Now that, just to be clear, that was done as a matter of financial stability. It wasn't a social policy intervention, because that's not for us. But I would say that one thing that I think will help is that does obviously limit some of the more extreme impacts that we've had in the past. We've also, again, this is not to do with the Bank of England, we've got much stronger protections in place now for, which mean that there will, people do not have their houses repossessed in the ways that they used to be repossessed. Again, my old crew at the FCA have been very active in that field, and I think that's appropriate. But let me come back to the first point I made. You're right. Of course, these things have serious impacts. We're very sensitive to this, but if we don't tackle inflation, it will be worse for people. That's the bottom line, I'm afraid.
That's all we have time for. Thanks very much, everyone. Oh, go on. Go ahead.
You've been very patient. I don't.
Thank you for taking my question. Lucy Haga, M&I Market News. Just wanted to ask, given the recent volatility in the projections, can financial markets still rely on the Bank of England's longer-term projections as a reliable communication tool?
Well, we spend a lot of time, and we have a lot of staff who spend a lot of time assessing, volatility in financial markets to help us to read through that. And you're right. It is interesting. Now, it's interesting in the period before, since the MPC last met, that we've had obviously quite a lot of volatility in financial markets because obviously we've had some very, very high-profile events going on in world financial system. Curiously, we've done in the UK. It's been a little bit of a round trip, and we've ended up sort of not far off where we started. So that made the MPC's task a bit easier in this case sometimes. But no, look, we have to spend a lot of time interpreting this because of understanding the underlying reasons and the likely sort of follow-through of these things and how persistent they will be. Ben looks like he's...
No, I just wanted to come in on sort of a couple of points about the nature of our forecasts. I mean, first, I don't think they're intended to communicate something, say, about future policy. Historically, they were intended more to explain the current decision. Because of these long lags in policy, we have to make forecasts. Sometimes I wish we didn't, but we have to make forecasts. And we use them to explain the current decision rather than to say, here's what we're going to do for the next 2 or 3 years. The second thing I'll say is from the beginning, this was always viewed as very important and is still very important. They are fan charts. They're probability distributions. They're not point estimates, and they're not point forecasts, and that should be understood. And then the third thing is something we said earlier, is they're conditional. And people on the outside may have different conditions, and that's fine. There are loads of people who make forecasts. I don't think people think, okay, well, I'm going to rely only on the Bank of England who makes a particular kind of forecast. Indeed, a whole range of numbers within the fan. So I'm not sure we view it as a kind of communication device about what will happen in the future, still less what will happen to interest rates in the future.